Everyone is getting excited about this rally, but I'm getting a bit suspicious. The official reason why Bitcoin and Ethereum, etc., everything is going up is because of regulatory changes. So apparently the US is becoming even more crypto friendly, and then the macro backdrop, as in the Federal Reserve bought long duration bonds and did this with short duration bills. Now there's always a good reason and there is the real reason. I think the real reason is different to what everybody believes. Because we have to ask ourselves, why is Bitcoin going up by only 23% while Ethereum is going up by 31%? Because usually when we just come out of a bear market, it's Bitcoin that gets bought first. And then over time, as we turn around, then people become more risk on and buy into Ethereum, eventually Solana, and then into the altcoins. So really, usually during a recovery, we should see Bitcoin at least performing as well as Ethereum. Also, the fact that the rally in crypto was that quick hints towards just a few big players buying very quickly, right? If this was retail buying, then usually this takes some time, right? Retail people tend to buy in slowly, they tend to build momentum, and then over the days, over the weeks, we see appreciating prices. If the price pushes up that quickly, it tends to be a few players with a lot of capital, potentially leverage pushing up the price. Now those big players, they just think in terms of opportunity costs, not necessarily in terms of US dollar prices, right? So it's just a question, should we buy, for example, artificial intelligence stocks, or should we buy crypto? For our risk on part of the portfolio, for everything that's got a lot of volatility, should we buy A or B? Those big players, they don't think about should we be in fiat currency or in investments. They just think about what is the best risk on investment at a particular point in time. And the stock market has been rallying a lot and is extremely expensive. This is the Shiller PE ratio, the price to earnings ratio for stocks over the very long term. This chart starts in 1870, so this is 150 years of data. And stocks are now very expensive relative to the earnings. And in the end, that's what we buy, right? When we buy a stock, we buy the future earnings of a company. In other words, now it takes more than 40 years just to break even. Now, the problem, of course, with that argument is that we could have made the same at the end of the 1990s, because that's when we hit the valuations of the peak just before the Great Depression, but we continued to rally further. So consequently, this year could also be reasonable. Maybe over time, stocks do become more expensive relative to the earnings, because earnings growth rates might accelerate, because adoption of stocks in general as an investment vehicle increases over time. Maybe also because capital markets become more and more global and the US is simply choice number one. So we don't have to turn around at the current valuations. However, the question is always about opportunity costs, and especially artificial intelligence stocks are extremely expensive. And my impression is that this bull market has heated up to a degree that the bubble might pop rather sooner than later. This here is NVIDIA relative to the Nasdaq 100. So the number one AI tech stock relative to all the other 100 stocks. Now have a look at what happened in the last 2 years. NVIDIA as number one with a lot of monopoly gains, with a lot of market power. It barely outperformed the rest of the tech sector. That's not normal. We would expect that when artificial intelligence grows very quickly and when there is the one leading company in the space, that NVIDIA should actually do better. Now, we don't have Anthropic, for example, in the Nasdaq 100. So that's definitely not the reason why NVIDIA can't outperform. Something else is happening here. And what I believe is happening is that people just look for more and more risk on investments. So it's very similar to the crypto market. Usually it's Bitcoin that appreciates first after we come out of a bear market. Then there's a rotation into Ethereum. Then there's a rotation into Solana and then into the altcoin. So people get more and more risk on. Now, when we don't see NVIDIA outperform the other 100 technology stocks that much anymore, probably people are just rotating their NVIDIA gains into more risk on AI stocks. That's the thesis. And one of those riskier investments was, for example, SK Hynix in Korea. And that might be the canary in the coal mine. The more riskier stocks got pushed up that much that they can fall by more than 50% in a bit over a month. And SK Hynix is the second largest stock in all of Korea. And so the crypto market works in the exact same way, right? At the top, we've got the Bitcoin price. At the bottom, we've got the Bitcoin dominance. So first, we see a rally. We see how we come out of a bear market. And in this case, Bitcoin appreciated by more than 600%. Once it had appreciated enough, then the alternatives come out. At that time, it was Ethereum, and it pushed down Bitcoin dominance. So Bitcoin became a less important part of all of crypto. Then came the bear market crash. Bitcoin was able to lose a bit less than the rest. Then came the recovery from the bear market, where Bitcoin dominance also grew, but then the growth of Bitcoin's dominance stopped after we have already clearly turned around from the bear market. So more than 800% gains from the bottom. Bitcoin dominance crashed because people rotated into Ethereum, Solana, and the altcoins. This was another altcoin rally. Bitcoin still made some gains, but the vast majority of money was made in the more risk-on assets. This is the rotation I'm talking about. So first, we've got our bull market, then we've got the acceleration of the bull market, and then everything comes crashing down. And so we could draw the parallel for AI. What's Bitcoin dominance in the crypto world could be the ratio of NVIDIA to the Nasdaq 100. So the leader is not outperforming anymore. Instead, it's things like SK Hynix, so much smaller stocks, much riskier stocks. And then once they have made their gains, once they are imploding, the momentum might finally turn around. And so how does this relate to the crypto rally? Because this was very much specific to crypto, right? We did not have this in artificial intelligence. Crypto out of the blue suddenly rallied. And again, I think it's a matter of opportunity costs. This is an institutions-driven rally. Otherwise, it wouldn't have been that fast. Have a look at the Bitcoin relative to the Nasdaq 100. So two competing asset classes, both attracting similar kinds of investors, right? The risk-on investor that wants to get outperformance, but is willing to pay for that outperformance with more risk, with more volatility, with more ups and downs. Sometimes Bitcoin outperforms, sometimes it underperforms. And it did underperform quite significantly in the last year. Now, how much will Bitcoin outperform long-term versus the Nasdaq 100? That's not clear at all, right? It seems like the crypto market has already matured and there is not much more outperformance. But if we just take this trading range, then Bitcoin still has roughly 100% to go from here in terms of relative performance. Now, this outperformance could come in many forms, right? It could be Bitcoin's price just doubling. It could also mean that tech stocks suddenly crash by 50%. It could also be a mix out of the two, right? A bit of outperformance of Bitcoin, a bit of underperformance of the Nasdaq 100. But the trend seems to be quite clear. AI stocks look very risky. AI stocks seems to have lost their momentum. And so Bitcoin as an alternative, given that it's so cheap, doesn't look that unattractive. The same kind of chart, by the way, we can draw with the entire cryptocurrency market cap relative to the Nasdaq 100. The potential outperformance is somewhere around 100%. So it's very hard to navigate this market, right? We can't just buy one asset class and hope for the next 10x. We really have to shift capital, and potentially we have to bet on falling prices of one asset and on rising prices of another asset. That's in general how I try to make most of my money. I, for example, bet on falling altcoin prices and then on a rising Bitcoin or Ethereum price. I bet on the difference between two very similar assets, right? Let's say WTI oil versus Brent oil. When they diverge, we can also bet on them converging again, or we could also bet on funding rates. The fundamental idea is that we want to make income irrespective of the macro environment, because the macro environment is just so unpredictable right now. There's nothing super cheap. There are only assets that are comparatively cheap to others, but that doesn't necessarily mean that there is steal in isolation. They are only cheap comparatively speaking. And so we have to bet both sides, the expensive side to go down, the cheap side to go up comparatively. Now, if you've been following this channel, you know that betting on altcoins can be very profitable. This is my track record over the last 2 years. But I've also recently published Bitcoin strategy Autopilot, so we can invest into individual strategies that automatically trade. This is the performance since we started 20 days ago. That's across all 3 strategies. So we've got stock funding rate arbitrage, we've got the oil price convergence, we've got Bitcoin trend following, where we bet on the best back-tested trend following strategy. and more vaults, more strategies are going to be started very soon. More details are on the website down below in the pinned comment. There is a 7-day money back guarantee. So in case you don't like premium, just message me within the first 7 days and I'll refund you. No questions asked. You get access to the trading signals either via Telegram or via email if you want to manually copy trade. You also get access to the automatic copy trading if you just want to deploy your capital and keep it running. There are some costs associated with this though. So there is a 2% management fee and a 10% performance fee. So the 2% is on the AUM, on the capital that you deploy per annum. The 10% is on the profit that's been generated. But again, more is explained on the website. Feel free to check it out. And as usual, thanks for watching. If it's your first time here, feel free to subscribe. I publish videos regularly. See you next time. Cheers.